Lecture 5. In this lecture, we're going to dive deeper into the income statement to see how we're going to analyze revenues, receivables, and operating income in other items. So the income statement is going to tell us how profitable the company is and how does the company achieve that profitability. And finally, it may offer users to predict company's future performance, right? For example, will the current profitability level persist in the future, in the near future periods? So to answer these questions, okay, the ratio analysis is just beginning. Okay, we're going to go deeper into the item analysis to see how we can achieve those goals. So let's talk about the classification of income statement. The net income can be decomposed into income from continuing operations and income from the gain or loss, basically from discontinued operations, net of tax. So most of the net income we expect to continue or to persist into future periods. We expect those operations to continue. But some of these operations will be discontinued in this period. For example, a company may sell one of the divisions. Okay, so this division will be continued. However, any gain or loss from this division before it was sold, okay, will be reported in this section, income and gain or loss from discontinued operations. And these will be reported as a net of tax result. Net of tax result. Therefore, for sure, we're going to focus on the income from continuing operations. The income from continuing operations can be expressed as three items. Operating income. So operating income is from the operating activities. And we know operating activities is a company's primary transactions. So if we are merchandising companies, we buy inventories and we sell inventories. Those are the operating activities, right? The next is non-operating activities, the non-operating gain or losses. The non-operating activities relates to financial, for example, and security investment activities of a company. And we're going to focus on the operating activities, operating income, because its operating activities drives company's performance. And the third component is provision for tax, the tax part. Now, if we look at specific count for operating income, we have revenues, right, and operating expenses, which include cost of goods sold, right, the SG&A expense, selling, general, administrative expenses, R&D expenses, and depreciation and amortization expenses. Those are related to company's primary business activities. The non-operating items, we have interest income, interest expense, right, then gain or losses from investing or financing transactions.